I've spent 30 years watching people's lives blow up because they treated a home purchase carelessly, losing their dream home and their hard-earned deposit monies. If you don't open your eyes to these 14 traps, you aren't buying a dream. You're setting yourself up for a costly problem. This video is for people planning to buy a home or already in the process. 3 reasons to watch this. First, to avoid losing your $5,000, $10,000, or up to $25,000 deposit. Second, to stay in control during one of the most stressful purchases you'll ever make. And third, to bring clarity and structure to what's primarily an emotional decision. Let's start with the one mistake that can stop your entire purchase before it even begins. And that is not getting pre-approved for a mortgage before you start shopping. It's actually one of the most important mistakes people make. If you're touring homes without a pre-approval in your pocket, you aren't a buyer. You're just a tourist. A pre-approval isn't a formality. It's your entry into the game. It means that an underwriter, the person who actually decides whether or not to grant your loan, has reviewed your application, your income documentation, tax returns, and credit report. And then they've issued a commitment letter stating exactly how much money they're willing to lend you. That's what sellers and listing agents look for before taking an offer seriously. This is completely different from a pre-qualification where a loan officer writes a letter based on their opinion that everything looks good. But it's still subject to that underwriter approval. That letter isn't worth the paper it's printed on in a competitive market, or really any market for that matter. Sellers don't have time for tourists. When the one hits the market, you may have hours, not days. If you have to call a lender after you see the home, you've already lost it to someone who was prepared. Don't be a spectator in your own financial future. Get the pre-approval first or stay on the sidelines. But even with a pre-approval, most people ignore the free leverage that's sitting right in front of them. Mistake number 13, not knowing about down payment assistance programs. There are over 800 down payment assistance programs in this country. Yes, I said that, 800 programs. We're talking about grants, forgivable loans, and low interest second mortgages. This is real money that most buyers either don't think to ask about or they ignore because they believe they make too much or the paperwork is just too thick. Leaving $15,000 or $20,000 on the table because you don't want to do some paperwork or research a grant is just laziness. And it could be the difference between buying a house or continuing to rent. A forgivable loan is exactly what it sounds like. Money that you borrow, but that you don't have to pay back. Usually after you've lived in the house for a set number of years, like 7 years or 9 years. Some programs are income-based, while others could be tied to specific professions like teachers, nurses, or first responders. But here's the catch. There is no such thing as free money. The money they're giving you has to be replenished so that they can help the next person. How do they do that? Well, by charging an interest rate that's anywhere from 0.5% to 1% higher than a standard market rate. On a $400,000 loan, a 1% higher interest rate costs you roughly $250 more every single month. In just 40 months, you've paid back that $10,000 grant in extra interest. If you stay in that house for 10 years, that $10,000 gift just cost you $30,000. Well, that's not a gift. If you have the cash, don't use these programs. Take the lower market rate. You'll save tens of thousands of dollars over the life of the loan. But if you don't have the cash, take the program. Okay? The higher monthly payment is the trade-off to stop being a renter. It's better to pay an extra $200, $250 a month to gain an asset than to pay $2,000 a month in rent owning nothing. Whether you use a down payment assistance program or not, there's another mistake that stops buyers cold, and that's mistake number 12, assuming you need 20% down. This myth has kept more buyers on the sideline than almost anything else. 20% down isn't a requirement. It never was. Conventional loans can go as low as 3% down through programs like Home Ready or Home is Possible. FHA loans require just 3.5% down and are much more flexible on credit. And if you're a veteran or buying in a qualifying rural area, VA and USDA loans require nothing down. So where did the 20% number come from? Well, private mortgage insurance, also known as PMI. It's a monthly fee lenders charge when your equity is below 20%. It's an insurance policy that protects the lender, not you. So the question isn't, can you put 20% down? It's whether waiting to do it actually helps you. Because while you're saving for 20% down, the market is also moving. If prices are rising, you're not catching up, you're falling behind. If you wait 2 years to save 20% on a $400,000 house and the market moves just 5% annually, you didn't save up $80,000. You lost $41,000 in equity and are paying $450 more in monthly principal because the prices went up. That $120 PMA payment was actually a bargain. The good news, you can always refinance out of an FHA loan when you reach 20% equity to get rid of PMI. And on a conventional loan, it drops off when you reach that 20% equity as well, either through payments or market appreciation, though you may have to request it. And in a rising market, 20% arrives a lot faster than you'd expect. So stop waiting for the perfect down payment and start owning that asset. Talk about it with the lender. And once you have, the next mistake is not talking to another. Mistake number 11, only talking to one lender. Most buyers talk to exactly one lender. Usually it's someone they got from mom or dad or their agent, their realtor. And look, they all mean well, but the parents haven't bought a house in 20 years. And your agent, they want a lender who can close fast. And they're usually not involved in the financing aspect of your purchase. The reality is that talking with only one lender removes the competition that gets you the best financial package. When you don't have competing loan disclosures, you're essentially bringing a knife to a gunfight. Let's talk about the rate versus APR hierarchy. Don't ignore the interest rate because it is important. But the APR, which stands for annual percentage rate, is the lender's confession. It's the only place where they're legally forced to admit exactly how much they're pocketing from you up front. If you don't check that confession, you're consenting to being robbed. Think of it this way. The interest rate is the monthly cost of borrowing the money, but the APR is the all-in cost of the loan. It includes all of the interest plus every fee the lender is tacking on. Without a side-by-side comparison, a lender could pack your loan with fees, and you'd never know you could have potentially saved hundreds or even thousands of dollars upfront and over the life of the mortgage. To run this comparison, you need the official 3-page loan estimate. Don't settle for a fee worksheet or a scenario or loan scenario as they call it, because they don't offer you any legal protections. Once a lender issues an official estimate, they can't just change their fees later without a valid reason. Imagine 2 lenders. Both offer you a 6.5% interest rate. On the surface, they look identical, but their APR tells a different story. Lender A has an APR of 6.55%. Their internal fees are lean. Lender B has an APR of 6.75%. Even though the rate is the same, the actual interest rate, they've added thousands in fees. Lender B isn't giving you the same deal. They're baiting you with a competitive rate while burying their profit in the price tag of the loan. This is why you compare the loan estimates side by side. Here's the pro strategy. Set the stage early. Before they send the quote, let every lender know that they're in a competition. Tell them, I'm going with the lender that provides me with the best combination of rate and fees. Check the gap. Look at the gap between the interest rate and the APR. The larger the gap, the more fees that you're paying to buy that rate. When a lender knows you're looking at the APR and comparing it to their competitors, you're no longer just a customer. You're the prize. And the prize should go to the lender who values your financial well-being as much as you do. If they can't beat the other guy's APR, they don't get your signature, period. But even the best loan in the world won't save you if you're waiting for a market that doesn't exist. And that brings us to mistake number 10, waiting for the perfect market conditions. Most people are sitting on the sideline, waiting for prices or rates to crash while they bleed rent every single month. Here's a fact that you can Google right now. In 2025, the average homeowner had a net worth of $430,000, and that was 43 times greater than the average renter who has a net worth of $10,000. And that gap is widening. Here's another question for you. As a renter, are you paying a mortgage? You are. It's just not yours. The most expensive mistake that you can make isn't buying a house with a high interest rate, it's waiting for a lower one. While you're sitting on the sideline waiting for the perfect market, you're missing out on the single greatest wealth builder available. I'm sure you've heard people say the market is going to crash, that prices will fall and rates will plummet. Well, those people have been waiting for years, bleeding more and more rent, yet the market continues to climb. Here's the reality. You can't time the market. But let's say the market does crash. Then what happens? Well, there's a lot more competition. When rates drop, every person that's been sitting on the sideline jumps back in. You might save a little bit on the interest, but if you have to pay $50,000 more for the house because of a bidding war, what are you really saving? And if the market doesn't crash, homes will continue to appreciate. If prices go up by 5% while you're waiting a year for a better rate, you may have just priced yourself right out of the very market that you were trying to time. The pro's perspective: marry the house, date the rate. You can always refinance when rates go down, but you can never buy a home at yesterday's price. Bottom line, stop trying to outsmart the market. Ask any homeowner who's been in their house for a few years whether they bought at the perfect time, and most will tell you no. But ask them what they'd change today. They'll almost always say, I wish I'd have done it sooner. You don't need a perfect market. You need a clear goal and the confidence to start building your own equity instead of creating someone else's. Are you currently waiting to buy? Drop a comment and tell me what's been holding you back. So now you're confident about owning your own home, but that doesn't mean being blind to the math. If you only budget for the mortgage, you're setting yourself up for a financial crisis on move-in day. And that brings us to mistake number 9, ignoring the true cost of home ownership. Owning a home comes with a few additional costs beyond the mortgage, but none of them should catch you off guard if you plan for them up front. Your mortgage covers principal and interest, but that's just the start. Most lenders also roll your property taxes and your homeowner's insurance into your payment and hold it in an escrow account to pay when they're due if you put less than 20% down. Add PMI to that. This combined number, called PITI, principal, interest, taxes, and insurance, is your actual baseline. And remember, if your taxes or your insurance premiums go up next year, your monthly payment goes up with them. Then you have homeowner maintenance. Experts recommend you budget 1 to 3% of your home's value every year, depending upon the age of the home. For most people, that's a few $100s a month. And on some months, you won't use any of that money at all. Add in utility costs, HOA dues if there's a homeowners association, and yard care. Then factor in the day one costs, window coverings, appliances, new furniture. Add it all up before you decide what you can really afford. The mortgage is where the bill starts, not where it ends. If you're down to your last dollar after closing, you're not set up for success. You're exposed. That's how people become house poor, which is where the payment is so high, it squeezes everything else financially. Choose a payment that supports your life, not one that controls it. Now that you're setting aside cash for maintenance and those early ownership costs, protecting that money matters. And this is where a lot of buyers lose out without even realizing it. Mistake number 8 is not negotiating closing costs. Most buyers just accept the closing costs that their lender presents them with. That's a mistake. Closing costs are not one big immovable bill. They're a collection of fees, and many of them are negotiable if you know which ones to look at. When you look at your loan estimate, you'll see closing costs typically run between 2 and 5% of the purchase price. But they land in 2 buckets, non-negotiable and negotiable. The non-negotiable fees are going to be things like government fees, like recording fees and transfer taxes. Those aren't negotiable. Same thing with prepaids, like your hazard insurance policy and property taxes, though you can choose who your hazard policy carrier is. And title insurance rates are often set by the state. These are all fixed. The negotiation zone is where the lender's fees live. Origination fee, processing fee, underwriting fee, document prep fee. These are often just pure profit centers for the lender. They're charging you for the privilege of giving them your business. The lender is already being compensated through the interest rate that they're charging you. They have employees to determine who they're going to lend money to. That's just their cost of doing business. But then they're turning around and charging you for those jobs. That's about as absurd as going to a restaurant and being charged a griller fee when you order a burger. I mean, think about it. You expect the price on the menu to be the price you pay. If they hit you with a $3 fee on top of that to pay for the person cooking it, you'd be furious, right? Well, that's exactly what the mortgage company is doing with these fees. So how do you fight it? Well, the loan competition or lender competition that we talked about earlier. Hopefully, there aren't any of these fees on your loan estimate. But if there are, tell your loan officer, I like your rate, but what can you do about these junk fees? Remind them that they're competing against other lenders who will charge you more fairly. You'd be surprised how fast those required fees disappear when they think they're losing you. A person who could be a 30-year customer to their competition. In most markets, you can also ask the seller to cover a fixed dollar amount of closing costs as part of your offer. This keeps the cash in your pocket that you might actually need for things like new furniture or a moving truck. If the seller won't agree to cover your closing costs directly, you can sometimes build them into the purchase price. If the appraisal supports the higher price, the higher value, the seller credits the difference back to you at closing, effectively paying for your closing costs. There's also rebate financing. You can take a slightly higher interest rate and the lender gives you a credit to cover your closing costs if you qualify for that higher payment. Don't just accept the number on the page. Review the line items, ask them to help, and don't be afraid to push back. By the way, you could also look at new construction homes. Most builders offer incentives that cover their buyers' closing costs. But even with the closing costs taken care of, the next mistake is a disaster waiting to happen. Mistake number 7, the zero reserve financial bomb. This mistake doesn't show up at the closing table. It appears months later when something breaks and you realize you have no money to fix it. When you're renting and the water heater dies, you call the landlord. When you own, it's your problem and your bill. If you empty your entire savings account for your down payment and leave yourself with zero cash reserves, you're walking into a financial minefield. These aren't maybe costs, they're when costs. They're real and they're immediate. You're gonna have your move, right? Hiring movers, renting a truck, plus paying for boxes and packing materials can run hundreds or even thousands of dollars. If you're buying new construction, there's the new home tax. That's because you're going to need to pay for window coverings and backyard landscaping. These things will bleed your cash. And when something inevitably breaks or fails, what are you going to do? That's why I'm a huge proponent of getting a home warranty. Now, this video is not sponsored by any warranty companies or anybody for that matter. On a resale purchase, you have to rekey every exterior door. Okay, most buyers don't realize this, but many home warranties include a rekey service. They'll pay to change the locks the day that you move in, ensuring you're the only one with a key to your new life. Without a home warranty that offers that feature, you might have to drop $400 to get that done. That's one problem solved immediately. And if something major fails, like your HVAC system or your water heater, you're not staring at a $5,000 hit. You're paying a small service fee instead. Just make sure that your core systems and appliances like washer, dryer, refrigerator, water softener, etc., are covered too. Okay? Make sure that you get any add-on policies or riders that you need. And if there's a pool, make sure that's covered also. But understand that there are limits. This isn't a blank check. A home warranty will not cover pre-existing issues. You still need to maintain the home as well. When something breaks, there are service fees of $75 to $150 per claim, and the warranty company, not you, decides whether to repair or replace the item. The pro move, ask the seller to pay for the first year. It's usually just a few $100s, and sellers will often agree to do it. The point is, don't let your down payment leave you broke. If you're walking out of closing with nothing left, you're exposed. Have at least 3 months of house payments in reserve in your account. Getting into the house is step 1. Being able to stay in it comfortably, that's the whole game. But all of that falls apart when emotion overrides the numbers. And that brings us to mistake number 6, letting emotions override your budget. Buying a home is emotional. It's where you build your life. But here's what happens more often than you think. Buyers find a home at the top of their budget, sometimes even past it. They tell themselves they'll figure it out. They stretch, and then they buy it. Then reality hits. Every unexpected expense becomes a major problem, and the house that felt so exciting starts to feel like an anchor dragging you under the waves. Lenders are going to approve you for your mortgage based on what you qualify for, not what feels good for you to live with. So set your payment before you start looking. Not your max approval, but a comfortable payment, one that you can live with. And don't get distracted by staging or model home decor, because none of that comes with the house. If you're making an offer because the home feels right without considering how your life will fit into it, you're setting yourself up. If the layout doesn't work, it doesn't work. If there are problems, they don't go away because the house looks good. Strip the house down in your mind. Picture your furniture and life in it, not theirs, not the previous owners. I break all of this down in detail in another video titled, You're Touring Wrong. Here's how buyers choose the right home. I'll link it in the description below. A house should support your life, not strain it. But even if you get all of that right, buyers still get caught off guard by one thing, and that is what it actually costs to fix or update the home once it's theirs. Home improvement and do-it-yourself TV channels have done real damage to the way people think about renovation costs and timelines. A full kitchen remodel isn't done in a weekend, and a new bathroom, it costs a lot more than $4,000. In 30 years, I've never, not once, seen a renovation come in on budget and on schedule. Not once. If the home needs a few repairs, the seller may offer you a credit to fix them yourself. But this can be a real gut punch after closing when you discover the $2,000 credit you negotiated based on what you'd seen on TV doesn't come close to the real cost of the roof and plumbing repairs that your home inspector flagged. If you're buying a fixer-upper or the home needs repairs like in the example I just used, get a minimum of 3 bids from licensed insured contractors before accepting a seller credit. Most contractors underbid to get the job, but they'll charge you the full price at the end. That's why you add 15 to 25% on top of their bid just to make sure you're covered. Materials get back ordered, demo uncovers surprises, timelines slip, and labor costs follow. Every time. If the numbers don't support the price for a fixer-upper, renegotiate or walk away. And if the credit won't cover repairs on a traditional purchase, either ask for a bigger credit, decline the credit and ask the seller to make the repairs, or be willing to use your savings to fill the financial gap. Or walk away also. I know, by this point, you're emotionally committed and walking away is tough. But guess what? They are also. The seller doesn't want to have to start over. They may have found a house that they'd lose out on if you were to cancel. So they're likely to work with you to come to a solution. But even if the numbers work and the seller agrees to every repair, there's one mistake that can still blow up your deal at the last minute. What you do financially after you go under contract. And that's mistake number 4, the new house spending spree. This is the most painful mistake because it's entirely self-inflicted. You get the call that you're clear to close and you celebrate by going to a furniture store to just look. Well, the next thing you know, you're financing a $3,000 couch and they're telling you that it won't affect your credit and it won't affect your home purchase. Well, that's just not true. Congratulations, you're now the proud owner of a $3,000 couch and 0 house to put it in. And if you gave notice on your rental, you're also homeless. Don't do it. The rule is simple. From the day you apply for your mortgage until you physically receive the keys, no new credit accounts, no large purchases, no new loans, and don't co-sign for anyone for anything. Oh, and no new job either. Your lender will do a final credit refresh right before you close. Any new debt changes your debt-to-income ratio, shifts your credit profile, and can cause them to revise your interest rate, put the closing on hold, or pull your approval entirely, costing you the home and your deposit, even if you've already signed your loan documents. The furniture will go on sale again. The new job will wait. Nothing is worth risking your new home over. But before the keys are in your hand, there's one more way buyers put themselves in a bad position. And that's mistake number 3, making a bigger down payment than you need to. You worked hard to save for your down payment. That's real discipline. But using all of it to maximize that down payment could be the most expensive decision that you make. We covered the need for reserves in mistake number 7. This is how most buyers end up without them. They believe more money down is better, but it's not if it leaves you completely exposed. Here's what extra down payment money actually gets you. Every additional $1,000 that you put down lowers your payment by $6 to $7 a month. That's it. At today's interest rates, that money has almost zero leverage on your payment. But in the bank, it's your safety net for everything that comes next. So ask yourself which is better, a $70 lower payment or $10,000 in the bank when an emergency pops up. A smaller down payment with healthy reserves is the smarter math. But even if your bank account is protected, your investment is only as good as what's happening outside your front door. And that brings us to mistake number 2. Focusing only on the house and ignoring the neighborhood. Buyers fall in love with interiors, the layout, the finishes, the light coming into the kitchen through the windows, and they rarely think about what's happening outside those 4 walls. Then they move in and discover the commute is brutal. The school district isn't what they assumed. There's nowhere for guests to park. And the neighbors, they love to party every night until 3 a.m. Unlike the kitchen cabinets, none of that can be changed. But here's how to really evaluate a neighborhood. 5 quick checks. First, drive it at different times. The same street can feel very different at 10 p.m. on a Saturday, noon on Tuesday, and 7 a.m. on Monday. Look for the neighborhood trend. The other homes in the community, do they look cared for? Are you seeing pride of ownership or decline? If you're buying a house in a neighborhood where the neighbors are letting their roofs rot, it's a bad investment. Look at the commercial trend. Are local businesses moving in or are they moving out? New coffee shops and grocery stores are a sign of growth. Boarded up storefronts and for lease signs everywhere are a major red flag. The value driver. Check school district ratings. Even if you don't have kids, school quality is one of the strongest drivers of long-term property values. When it's time to sell, that rating is your insurance policy. Lastly, check crime statistics. Don't go off of a gut feeling or what the seller tells you. You're not just buying a home, you're buying into a community. What's one neighborhood deal breaker that you'd hate to discover after moving in? Let me know in the comments. So we've reached the final mistake, and it's the single most damaging mistake a home buyer can make, and completely 100% avoidable, and that is skipping the home inspection. In competitive markets, buyers do whatever it takes to make their offer stand out, bidding above asking price, shortening timelines, waiving contingencies, including the home inspection. That decision can be financially catastrophic. A home inspection is a professional evaluation of the structure, roof, electrical, plumbing, and HVAC system. It costs between $500 to $750. Compare that to what it uncovers. Depending on your market, a roof replacement could cost $15,000 to $25,000. Air conditioning, HVAC failure, $8,000 to $15,000. And foundation issues, $3,000 up to potentially $50,000. None of this is visible during a standard showing. And remember, the home warranty we discussed in mistake number 7, it doesn't cover pre-existing conditions. If the issue was there before you closed, the warranty won't touch it. Here's what most buyers don't realize though. The inspection gives you leverage. Even if you've waived that contingency, you can still have the home inspected. What you lose is the right to cancel and recover your deposit based on the results. If serious issues are uncovered, you can also still negotiate a solution. Ask for a repair, a credit, or even a price reduction. If the seller says no, you have the ability to walk. Okay? Walking away costs you the deposit, but buying a problem property could cost a lot more. And if the deal falls apart, the seller now has to disclose those issues to the next buyer or risk legal liability. That usually means a tougher sale and often at a lower price. That's why sellers are often willing to negotiate. If you only take one thing from this entire video, it's this: never, ever, ever skip the home inspection. So there you go, 14 mistakes from the ones that cost you money to the ones that can trap you financially. Every one of them completely avoidable. if you know what to look for before you buy. And that's exactly what this channel is here to do. If you're planning to buy a house in the next 6 to 12 months, subscribe. This is where you come to avoid expensive mistakes before they happen. And what I'm covering next is just as important as what you just saw today. If you know someone touring homes right now, send them this. It could save them from a very expensive mistake. In the comments, let me know which mistake caught you off guard. Thanks in advance for sharing. Buy smart, avoid the mistakes. I'll see you in the next one.